Thank you very much for inviting me here to speak today, and thank you, James, for saving me a minute. I'll probably need it. There's quite a lot to get through. I'm going to take a bit of a broader look, give you an overview of the UK economy, how I see it at present, and also where we're likely to see it go over the next couple of years during this particularly turbulent time. Now, first, I'm going to look a little bit at the early evidence on Brexit. Clearly, those dire warnings that the UK would face an immediate recession, a rise in unemployment, a drop in house prices, that wasn't borne out. And so looking a bit at that evidence and what we've learned since the vote. I'm then going to move on to whether that resilience can last. There are clearly some headwinds on the horizon, in particular a pickup in inflation and the impact that will have on consumer spending. And finally, I'll move on to the medium and longer term economic outlook, which is particularly uncertain at the moment, but I'll perhaps run through some of the potential options and what I think looks to be the most likely outcome. So this chart shows how the economy has fared since the referendum. We can see the black line is the Composite Purchasing Managers Index. It's a kind of closely watched survey that has a pretty good relationship with GDP growth. And we can see that immediately after the vote, it dropped very sharply and was pointing to growth of about minus 0.5. So for a time being, at least, it was suggesting that the economy was heading into recession. But then a month later, it rebounded very sharply. And since then has actually held on to that strength. So clearly we avoided that recession that was forecast to occur almost straight away. And at the moment, I think the key point is that it's actually still pointing to growth of around 0.5%. So we saw 0.5% growth in the third quarter, and assuming that it remains around its current level, we're likely to see pretty solid growth as well in the fourth quarter. Now, in part, that's due to strong consumer spending. So we saw a dip in consumer sentiment as well straight after the vote. That's shown by the blue line here. That's the GfK Consumer Confidence Measure. But again, that rebounded very quickly and was pointing to pretty strong growth in household spending as well. Now, it has fallen a little bit more recently, reflecting concerns about the economic impact of a hard Brexit and also the potential for a sharp pickup in prices over the coming years. But even that is it's still pointing to real household spending growth of around 2% per annum, so pretty reasonable rates of growth, all things considered. Now, the labour market has remained healthy as well, so that big rise in unemployment, that never occurred either. In fact, we've actually seen the unemployment rate fall to a post-crisis low of 4.8%. And wage growth hasn't taken a sort of material hit from the Brexit vote either. So at the moment, the labour market is looking pretty healthy as well. Now, I think what's particularly encouraging is that it's not just consumer spending which is driving the overall economy at the moment. It's actually quite broad-based. So this chart shows the contributions to quarterly real GDP growth, both in the second quarter and then the third quarter after the vote. And we can see that household spending clearly made quite a big contribution to growth, but we also saw investment rise as well, and within that, business investment was strong. And that was despite business investment being one of the areas that most people thought would be hit quite hard in the immediate aftermath of the vote. And net trade does also appear to have provided quite a significant boost. We saw exports rise very strongly and imports fall very strongly. I would caution reading into that a little bit too much, though, at the moment. There seems to have been some kind of one-off, temporary, erratic factors that was driving that. But nonetheless, I think that the overall picture is that growth was perhaps a little bit more broad-based than people thought it might have been. Now, as a result of that stronger incoming economic data, we've seen forecasters revise up their expectations for growth in the near term. So this chart shows expectations for growth next year in 2017 over time. So we can see that immediately after the referendum, everyone revised down their forecasts. Actually, the consensus, which is shown as the darker of the blue lines, and that fell from an expectation that growth would be about just a bit above 2% next year to about 0.5%. So they cut that forecast quite sharply. But since then, it's started to drift back up again as the incoming data has remained a bit more resilient than people thought. And now the consensus is expecting growth of about 1% next year. Now, official forecasts are actually a little bit more upbeat than that. So both the Bank of England and also the Independent Office for Budget Responsibility, who provide the forecasts for the budget, they expect growth next year to be 1.4%. So still a slowdown from this year's growth of about 2%, but certainly not a recession, only a little bit of a slowdown. And our forecast, for what it's worth, is 1.5%, and that's remained in place since the day after the vote. Now, it's worth asking the question, why has the Brexit vote not been more damaging? Why has the economy remained so resilient? I've put a few reasons up here, and I'll actually go through them in a little bit more detail now. But I think it's probably a combination of these factors that explains why the economy has held up. Now, first, on the face of it, there was a big shock. This is an index of economic policy uncertainty. We can see that it shot up rapidly around the time of the vote, and actually to a level that was far higher than even in the global financial crisis and also the Eurozone crisis as well. So uncertainty was very, very high. But it since fell back quite dramatically as well, although it still remains at quite an elevated level. But I think the key thing is that it wasn't a shock in the same way that the financial crisis was, in a sense that we sort of knew that it was coming. We were told as early as 2013 that if the Conservatives won the next general election, that there'd be a vote on EU membership. Then when the Conservatives did win the election, we were told that the referendum would be held. And we have to remember that the polls were still showing that the vote was going to be pretty close, even right up to a few days before. So it's not the same sort of surprise shock. There's at least some people that anticipated it, or at least businesses were better able to plan what might happen if the vote was to leave. And I think the other thing to note is that whilst it's not a sort of shock in the same way that the financial crisis was, in that a good portion of people actually got what they wanted. We have to remember that 52% of people voted to leave, so there's clearly some parts of the population that are actually quite pleased with the outcome of the referendum. Now, that perhaps helps to explain why consumer confidence has actually held up a little bit better than is suggested by the fundamentals. So this chart here shows the headline consumer confidence balance, which is the blue line, and then the black line shows a kind of a basic model which looks at the past relationship between confidence and things like interest rates, unemployment, house prices, inflation, the exchange rate, and what's happening to earnings. And we can actually see that confidence is a little bit stronger than is predicted by this sort of rather crude model. And that might help to the fact that some people are kind of happy with the outcome might help to explain a little bit why that's diverged. Now, the next reason I want to suggest for why the economy is held up reasonably well is that policymakers were pretty quick to respond. We saw the Bank of England cut interest rates in August by 0.25%, and they also expanded their quantitative easing program. And that was passed on to the actual interest rates that households and businesses fare quite quickly. So we see here the interest rate on fixed rate mortgages and also on unsecured personal loans, and they've been continuing to drift down and fell after the Bank of England cut interest rates as well. And despite talk of a punishment austerity budget, that never occurred either. So after the new Chancellor took up his position, he said that there was a chance to reset fiscal policy, to change what was going to happen over the next few years. And in the autumn statement, he did make some changes. I think reset is probably going a bit too far. It was more just a slight tweak. But nonetheless, he did change the path for fiscal policy over the coming years. So this shows the change in the fiscal stance, if you like, where if the bars are below the zero line, then that shows that fiscal policy is getting tighter. And if they're above the line, it shows that it's getting looser. I think the big picture here is that fiscal policy is still going to be tightening over the next few years, but it's going to be tightening at a less rapid pace than was previously planned. So the fiscal squeeze is going to be a bit less severe, and that certainly will do something to help prevent the economy from slowing too much further. And the Chancellor has also left himself a bit of room to respond and potentially loosen policy a little bit further and still meet his targets if the economy was to weaken more than the OBR expects over the next few years. Now, the next reason I want to give why the economy has held up is that the pound has been something of a shock absorber to some sectors. Now, this chart shows the Footsie 100, the UK stock market, against the trade-weighted value of sterling, where when sterling falls, it rises on the chart. And we can see that the relationship has been very close over recent months, and in particular, the fall in the pound appears to have driven up equity prices in the UK. And that's largely because foreign multinationals, the sterling value of their earnings obviously rises when the value of the pound falls. So clearly for some companies, the fall in the pound is a good thing, but not for everyone. So this chart here shows that Footsie 100 index and also the Footsie UK local. So that only includes firms that 70% of their sales are in the UK. And you can see that they've clearly done a lot worse than that overall stock market index. Now, exporters are set to benefit from this boost to competitiveness. So we can see here that export orders have already responded to that fall in the exchange rate. We've seen quite a sharp pickup in the PMI export orders balance, and the past relationship with the exchange rate suggests this has further to run as well. So clearly there are some negative impacts from the lower pound, and I'll go on to talk about the impact on inflation in a second, but for some sectors at least, it's helped to cushion the blow. So let me move on to inflation. I think this is clearly the big risk, perhaps one of the biggest risks to household spending over the next few years. Now, this shows a pickup in firms' input costs. So there's two ways that the lower pound is going to have an impact on inflation. The first is through a sort of direct impact on boosting import prices, but then it also has an impact on firms' costs, which then, if they pass that on, means that we'll see higher prices in shops in time as well. So we can see on the basis of past form here that the pickup in manufacturing firms' input costs points to consumer price inflation of heading up to 5% in about 6 months' time. So that, on the face of it, suggests quite a sharp pickup in price pressures. I think this probably overstates it to some extent, in particular because firms may not necessarily pass on all of the increase in the costs. They're likely to absorb some of that, given competitive pressures that we're seeing at the moment. And so it's actually probably going to be a bit less than that, but still quite a sharp pickup. So it largely depends on what you assume, both about how firms respond to the increase in costs, how much they pass it on, but also how quickly they pass it on as well. So this chart shows what our central assumption for inflation is. That's the dark blue line in the middle, and how that might vary if you change your assumption about how firms pass on those costs. Now, we think that inflation will peak at about or just over 3% in 2018. But if you assume that firms pass on more of the increase in the costs, then we could see inflation as high as about 4%. Equally, if firms decide to absorb more of the costs, then we might see inflation only peak at about 2.5%. So I think the key thing here is that there's a lot of uncertainty about how far and how fast inflation will rise. But inflation of perhaps around 3% seems like a reasonable ballpark for a peak figure in about 2018. And that's once all of these effects have sort of started to, or at least have fully fed through into that headline rate. I think one thing to note here is that, firstly, 3% inflation is obviously much higher than we are now. We're only at about 1% at the moment. But I don't think it's going to be particularly troubling for policymakers and the Monetary Policy Committee in particular. I don't think that it would force them to raise interest rates. It's also considerably lower than we saw after the depreciation in 2008, 2009. And obviously then we were also having the impact of sharply rising commodity prices, VAT hikes, and tuition fees as well. So inflation is on the way up, but to a level that is perhaps not too concerning. That said, wage growth is, although it's reasonable at the moment, it's still pretty weak by historical standards. And so we think that earnings growth will pick up a little bit, but probably not too much over the coming years. And at the same time, we've got inflation picking up to over 3%. So real wages are going to be squeezed over the next few years. And coupled with that, in terms of the labour market, while it seems to have been resilient at the moment, perhaps the worst is yet to come. So this shows here a range of survey indicators of employment intentions plotted against annual employment growth. And on the face of it, this suggests that employment growth is likely to slow quite sharply over the coming months. Not contract, but still slow very sharply. So the combination of that slower employment growth and also weaker real earnings growth means that overall real household disposable income is likely to grow pretty sluggishly over the next few years. Now, let me turn on to the longer-term economic outlook. I should say that while economic forecasts at the best of times should be taken with a pinch of salt, the longer-term outlook, that should come with a health warning. It's extremely uncertain at the moment, and that reflects just the sheer range of possible options which might be taken over the next few years. The UK has said that it wants a bespoke deal. It doesn't actually want any of these off-the-shelf options. It also wants the best possible deal that's kind of bespoke to the UK's needs. And so I think it's probably going to be a combination of some of these things, or at least the government wants to have a combination of some of these elements. And so I'll talk through about what I think will be the most likely outcome. So there's been a lot of talk about hard Brexit, soft Brexit, even a long Brexit. I think personally that there's a good chance that it will be a sort of soft-ish Brexit. So on the one hand, you've got people like Donald Tusk saying hard Brexit or no Brexit. We saw that earlier in the video clip. And the government saying Brexit means Brexit. So there's been some kind of hard Brexit type comments. However, as was mentioned earlier, Theresa May actually wanted to remain. Many Brexit voters themselves may have actually wanted a soft Brexit. We don't know. Clearly, immigration was one particularly important topic, but recent survey evidence suggests that also people want to have a pretty close trading relationship as well. So all we know is that people wanted to leave the European Union. We don't know any more than that. The government has also made some assurances or some reassurances to certain companies like Nissan and to industries like the financial sector. And so those reassurances suggest that we might end up going down more of a softish route as well. Also, we heard earlier about the parliamentary approval of Article 50. If Parliament does have to approve it, that could be conditional on having a vote at the end after the negotiations are in place. Again, that might push us towards more of a soft Brexit to ensure that it actually gets through Parliament. And finally, I think while we've heard some sort of voices from Europe that have taken quite a hard line, I think there is particularly with some European partners, there's a sense that we do need to end up with a pretty close relationship at the end of it. So I think, as I say, that we'll probably go down more of a kind of soft-ish route. Now, I've sketched out what I think that might mean on this slide here. So one, I think we'll probably have some sort of free trade agreement in goods, possibly some services sector access as well. Financial services seems to be the area that they're particularly concerned with. There's some questions over whether firms need the financial passport or whether they can use what they call equivalence rules in order to trade in Europe. But still, I think the financial sector is going to be one area that they're focusing in on particular. Controls over migration, I think, is clearly one of the big issues for them, whether that's in terms of absolute numbers or just a transition to more of a skills-based policy. There's some uncertainty there, but I think there'll be more controls on migration than are currently in place. And reduced contributions to the EU budget. I've not said no contributions. I think that we probably will end up paying some contributions to the EU budget, perhaps less than we're paying now, but that might be the price, if you like, for some of the other areas. And certainly the comments by David Davis today suggest that the UK would be willing to pay something in order for some more access to the single market. So putting this all together then, this chart shows our forecast for GDP growth over the next few years. As I say, it's all very uncertain at the moment. But I think our general picture is that we're likely to see a slowdown this year. Particularly, there's a lot of uncertainty at the moment about the triggering of Article 50 and how the Brexit negotiations go. But once that gets underway, and hopefully there'll be a little bit more clarity over what the government is seeking to achieve, that should help businesses plan accordingly. And we expect growth after sort of 2017 to pick up a little bit to a bit above 2% in 2018 and 2019. In terms of the breakdown, I think household spending is clearly going to be the largest driver of this. Households are going to find it difficult with real wages being squeezed, But given that households appear to have shrugged off Brexit so far, we don't think that there's going to be this build-up of precautionary saving. We think that households will actually reduce the proportion of their income which they save in order to fuel their spending. So I think that household spending growth should remain pretty robust over the next few years. I've already said that I think inflation is going to pick up, but probably will peak at about 3% and start dropping back thereafter. In terms of the labour market, we expect a little bit of a drift up in unemployment, but not to a particularly high level. It's about 5% now. We think it'll go up to about 6%. And we still think employment growth will be slow, but in positive territory. We think that interest rates will remain on hold, and obviously that will provide some support to households in order to help them through this period. And finally, just in terms of interest rates, we think that the pound will weaken a bit against the dollar over the next year as the Fed kind of presses ahead and starts raising interest rates. Against the euro, I think it's a little bit difficult. There's clearly going to be a very volatile period over the next year, and I think the volatility point is the bit that I want to stress the most. It's going to ebb and flow as we see different speeches from ministers potentially saying very different things. And clearly there's a lot of political uncertainty both in the UK but also in Europe as well with elections coming up next year. So I think it's going to be a very volatile time for that exchange rate. Now, very quickly, just to wrap up, clearly those dire warnings that the UK would face an immediate recession never happened. The early evidence has been reasonably comforting, although it's worth stressing that perhaps the slowdown hasn't actually been avoided, but just delayed, or it's going to be a little bit more drawn out. There's a lot of headwinds on the horizon, in particular this whole point about inflation, but also uncertainty about when Article 50 is triggered and how the process looks. I think policymakers still have room to provide support, though. So if the economy was to weaken more than we forecast, I think that the policymakers would step in pretty quickly. We'd probably see more of a loosening in fiscal policy. We could even see some more support from the Bank of England as well, if it was needed. Now, in the longer term, I still think it's very uncertain at the moment, and that's the point that obviously everyone knows, but it's just worth stressing that really nobody knows how it's going to end up. But I think there's clearly some reasons to think that we'll head down more of a soft-ish sort of Brexit. And as a result, I think the economy should be able to perform relatively well over the next few years.